What's up YouTube, it's Borat back at it again with another video. Today I'll be explaining the CeFi Black Swan blow-up risk that Preston Pysh talks about in a podcast that I'll link down in the description. Just to preface this video, none of this is financial advice and none of this is even guaranteed to happen. This is all just speculation from Preston Pysh that I personally find compelling and wanted to create a video about and share with you guys. So to understand this Black Swan blow-up risk scenario for the CeFi platforms, first we're going to have to understand what is an interest rate, what are the basics of value investing, and then finally, we'll talk about how this CeFi blow-up risk scenario would play out. There's a lot to unpack here, and I'm gonna try to make this as simple as possible, but if I do lose you at any point during the video, feel free to leave a comment down below or DM me over on Twitter, and I'll have my Twitter link in the description as well. And I'll do my best to explain my thought process in a more cohesive way for you to hopefully understand it a little bit better. Go down below and smash the like button for the return of real interest rates, and let's level up your brain. So first, let's understand what is an interest rate. Investopedia defines an interest rate as the amount a lender charges a borrower as a percentage of the principal amount loaned. So what the f does that mean? Basically, if I loan you $100 and there's a 5% interest rate, at the end of that year, I'm gonna be wanting back from you $105. In that example, I set the interest rate arbitrarily and you agreed to it because we just have some relationship where we're loaning each other money. In reality, the way interest rates get set in America is actually very complicated. But as an oversimplification, basically, the Federal Reserve decides what the interest rate for treasury bills is, and treasury bills are sort of like the most conservative investment. It's like the risk-free rate. And then every other interest rate flows downstream from that base risk-free rate, depending on how risky the investment is. So let's say a treasury bill has an interest rate of 1%. Maybe your mortgage, which is a little bit riskier than a treasury bill because you're not as financially sound as the US government is theoretically, maybe that mortgage is a 3% interest rate. But that mortgage is still a pretty conservative investment because it is collateralized by the physical property that you're taking the mortgage out against. And so maybe something at a higher interest rate would be maybe a junk bond, might be 4% in this case. And maybe a personal loan to you that's not secured by any collateral, maybe that's like an 8% loan or something. These are all just made up numbers, but it illustrates the point that the riskier and riskier the bet is, the higher and higher the interest rate needs to be to cover the default risk for the person that's lending out the money. And so now let's pretend that the T-bill, in the first scenario, it was 1%, but now let's say it's 0.5%. And so now everything downstream from the T-bill is also going to be affected by that change to the T-bill rate. Maybe your mortgage falls 0.5%, maybe the personal loan falls 0.5%, and then the opposite would also be true. If the T-bill went from 1% to 5%, your mortgage can no longer be 3% because your mortgage is riskier than the T-bill, so maybe the mortgage is now 8%. In the case where the interest rate falls though, which is what's been happening for the last 50 years in America, the money that the investors in these debt instruments are being returned every quarter, or every month, or every year, that money is getting less and less and less because the interest rate is getting lower and lower and lower. And so right here, I'll throw up a graph of the interest rates in America over the last 50 years. You'll see that they started at around 10% in 1971. They trended upwards to about 20% in 1980, and then they've fallen dramatically over time. And now today in 2021, they're closer to 0% than they are to 1%, hovering at about 0.08% as of the recording of this video. Okay, so interest rates used to be really high and now they're really low, but why does that matter? From a savings perspective, it means that back in the 1980s, you could put money in a savings account, which is basically a risk-free investment, and earn 20% interest on that money. It's no wonder that boomers who were working age in the 1980s have a ton of money today, and it's because the risk-free time value of their money in the 1980s, just putting it in a savings account, was enormous. So if they wanted to retire, they didn't need to chase yield by investing in risky tech stocks or crazy dog tokens. They could just park their money in a savings account and it would earn 20% a year or 10% a year or 5% a year for them. That interest rate environment existed until the early 2000s, and as those interest rates fell closer and closer to zero, savings accounts became a worse and worse investment in terms of being like a retirement vehicle. They're still useful to park cash in short term, but the US dollar is no longer the store of value that it used to be back in 1971. And that's where stuff like stock investing became a lot more necessary for retirement. So next, let's take a look at what is value investing, and we'll talk about how did these lower and lower interest rates impact the stock market. Value investing is an investment methodology that involves picking stocks that are trading for less than their intrinsic accounting book value and discounted future cash flows. The most famous value investor of all time is Warren Buffett, Berkshire Hathaway's CEO and famous boomer guy. Berkshire Hathaway is basically just a giant public hedge fund that Warren Buffett controls and uses to execute his value investing picks. Buffett basically went out and did a ton of research on the intrinsic accounting book values of these different companies and the values of their discounted future cash flows, and determined which ones were undervalued by the market. And one big metric that is commonly used in this analysis is called the PE ratio, or the price to earnings ratio. The PE ratio basically just divides the total price of the stock by the earnings of the stock, or in other words, it's the number of times that a stock would need to earn its current yearly earnings to justify its current stock price. So if my company was valued at $1 million and I make $100,000 a year, it would take me 10 years of this $100,000 yearly earnings to justify that $1 million valuation. And I would have a PE ratio of 10. And another way to say that is that my stock is valued at 10 times earnings. If you look at a chart of historical PE ratios of the S&P 500, you can see that PE ratios go down as interest rates go up, and vice versa. And because interest rates have gone down over time, PE ratios have trended upwards over time, and we're now sitting on PE ratios of the S&P 500 that are more than double of what they used to be. This means that the average company in the S&P 500 today is being valued at around double the price per earnings that they were back in 1970s. And that's because interest rates have a lot to do with valuing the discounted future cash flows of a business. If I can earn 10% in a savings account totally risk-free, I would end up putting less money into the S&P 500, which overall is going to drive down the price of stocks and drive down the PE ratios of those same stocks. What's happening today is that because interest rates are so low and that savings accounts are no longer a way to store your value, people are having to invest in the S&P 500. Everyone is using that as a store of value, and PE ratios are going up really, really high compared to what they were historically. By this point, a bunch of you are going, okay, I clicked on a CeFi video and this guy hasn't said a single word about Bitcoin or CeFi. Thank you guys for being patient with the background here. I think this information is actually really important to understand before we get to the blow up risk. So stick with me, and next we're going to talk about how interest rates and PE ratios are directly related to what's happening in Bitcoin and CeFi. And again, none of this is guaranteed to happen. It's a very unlikely scenario that I personally just find compelling and interesting to talk about. Currently, as we talked about earlier, this is an oversimplification, but interest rates are now being arbitrarily set by the Federal Reserve, who set the interest rate based on whether they want people to save more or spend more. And until today, there has been no competition for a risk-free rate. The only place you could go to get a risk-free rate was in savings accounts or in investing in T-bills or other government debt instruments. But what if there was some sort of alternative money system that was setting its own global interest rate 24/7, 365? This is what Preston and a lot of the rest of us think is eventually going to happen with Bitcoin. And there are a lot of different ways that a risk-free rate could be produced. The most obvious example of this right now is going to be when those contango spreads emerge, when people become really, really bullish about Bitcoin. If you want to learn more about these contango spreads and what that means, if you haven't been exposed to this idea before, I'll leave a link down in the description to a really great video that Trader University did a couple months ago, where he explains in really good detail what is Bitcoin contango and how is it producing basically a risk-free rate. So if this new interest rate develops, however it develops, I'm not saying that necessarily it has to develop through the contango spreads, but if that interest rate is established and it's significantly higher than what we're seeing today and it is a risk-free trade, if everyone rushes to execute that trade because that trade is yielding more than what even equities are yielding, and you're taking a risk when you're investing in equities, but you're not taking a risk when you execute this risk-free trade, you're only taking trade execution risk basically, and any competent trader would be able to put this trade on no problem. All of the equities and all of the money that is rushing to now execute this risk-free trade is going to drive down the PE ratios of all of these stocks that are in the market that are currently overvalued when you look at it from a historical PE ratio context. And this is where CeFi comes in. The institutional partners of these CeFi platforms do not have to over-collateralize the loans that they open with the platform. Those institutional partners likely also have leveraged debt and equity positions on their balance sheets, and if that movement from all of this money in the stock market to this new risk-free trade that has emerged, if let's say the new interest rate is 10% and those PE ratios drop to the historical level of a 10% risk-free rate, there will be a massive correction in the equity markets, and it will cause a leverage unwind to any of these institutions that are leveraged up with debt and equity. And in that leverage unwind scenario where these large institutions are getting margin called basically left and right because PE ratios are crashing, how will these CeFi platforms cover those losses? Because again, those institutions are not over collateralized. When I create a loan with one of these CeFi platforms, I need to deposit something like twice the amount or 3 times the amount of Bitcoin to get the loan, and that's a risk-free loan. But these institutions are not having to over collateralize their loan, and so if they take out a $1 million loan, there's nothing, or there's $500,000 collateralizing the loan, and that's not enough, right? You need to have completely collateralized the loan for it to be risk-free. When it's not over collateralized, these leverage unwind situations become a really big risk and possibly an existential risk. It's unclear how the CeFi platforms would react to such a crazy sell-off in the equities market, but it really illustrates the dangers of under collateralizing these loans and investing in these CeFi platforms when they haven't agreed to over collateralize every single loan. If they did agree to do that, I think their interest rates would fall, and unfortunately customers who are just chasing yield would maybe not invest in those platforms, but it would create a safer environment for those platforms to exist, and it would insulate them from risks like this. This is another reason that set it and forget it index fund investing has a lot more risk than people ever want to talk about. If the entire market is overvalued and interest rates spike, your whole portfolio will crash if you're just in index funds, because people won't want to take that risk of being in stocks when there's a risk-free higher interest rate available outside of stocks, either when treasury rates spike or when some sort of interest rate emerges from something like Bitcoin. Okay, so let's say all of that happens and you're holding Bitcoin. At that point, everyone is piling into this cash and carry trade. Equities have sold off. And what Preston is suggesting is that anyone holding Bitcoin at that point would then be able to scoop up a bunch of very cheap equity for pennies on the dollar and PE ratios that made sense 50 years ago, basically. And just to be clear, if the PE ratios were 6 like they were back in the 1980s, as opposed to 36 today, that represents about an 85% drawdown in the overall market. So these are actually really, really big numbers that we're talking about. All of this happening just from a new risk-free rate emerging that is much higher than the current 0% artificially manipulated interest rate that's been created by the Federal Reserve. So real quick, let's talk about what would stop this from happening. First of all, in reality, the contango spreads don't stay around for that long, and so the idea of creating a full-time interest rate in the contango spreads is, I think, maybe a little bit of a dubious idea unless Bitcoin is really, going parabolic, basically. In a hyper Bitcoinization scenario, I think it's very likely that the contango spreads would be higher and higher and higher, and that could develop a risk-free interest rate. And if you asked Preston, all right, what are you talking about? I think that's probably what he would say. So what could the CeFi platforms do to protect themselves? First of all, they could force all of their partners and institutions to over-collateralize their loans. This, as I said before, I think would drive down the interest rates that they were able to offer on the platforms and might upset people that are just out there chasing yield, which I think is really unfortunate. Puts them in a very difficult position from a business competition perspective. If one of their competitors is willing to create really high interest rates by not over collateralizing loans, then what are you going to do, kind of? What they could do is segregate their business into retail over collateralized and institutional not over collateralized, and just make you aware of the risk when you invest in one kind of platform or the other kind of platform. Maybe they say, hey, we have this 0.5% or 1% interest rate. You're guaranteed not to lose money. It's risk-free because all the loans are over collateralized. And as long as we don't mess something up or execute a trade wrong and execute all our business processes correctly, this is very low risk compared to what we're currently offering, which is higher interest rates. And in some sort of market liquidation scenario, this could be a very risky thing to be offering. Bottom line of all of this is not your keys, not your coins. When you invest your Bitcoin in a CeFi platform, it is no longer your Bitcoin. It is an IOU on Bitcoin that you have given to that CeFi platform, and they do not insure you against loss of that principal amount that you've deposited with them. Again, this could be fixed by over collateralization, but it does present business challenges for the CeFi platforms. And then as for what I'm personally doing, I'm only keeping stablecoins and Ethereum on CeFi platforms because I don't believe in, those currencies as stores of value basically over the long term. And I do still find the interest rates compelling for those assets that I am investing in the CeFi platforms. And I do like the ability to, for example, with Ethereum, create some sort of loan against my Ethereum and then use that cash as I see fit. There is utility there. And so I'm not saying that these CeFi platforms are all bad, but I have personally taken taken out all of my Bitcoin from CeFi Platforms after listening to this podcast that, again, I'll leave down in the description. Hopefully this video was helpful for you guys and helped you understand sort of what the biggest risk is to some of these CeFi platforms. If you did find the video helpful or interesting at least, definitely go down below and smash the like button so that YouTube shares this video with other people. Comment down below if you have any questions about what I said or if something that I said didn't make sense. I do still respond to all the comments, and YouTube actually arbitrarily removes some of the comments. So if you don't get a comment response from me in a couple of days, definitely reach out to me on Twitter over DMs and I will for sure respond to you over there. Subscribe and hit the notification bell for new videos every Monday at 10 a.m. Eastern. I love you all. Goodbye.